reporting. So long-term debt must be reported. It's one of the major things in a balance sheet. So here's an example for Verizon. It has all this debt, and on the far right side we have 2014 versus 2015. It lays out all the financings they've done, and this, if you look at the total dollar amount, is 103, and you look at the units, they're millions, so it's $103 billion that they owe in these varying amounts of types of loans. The rates move around based on when it's issued and the terms, but it's a lot of money outstanding, and the current portion is on the very bottom. You see $6.3 billion. So the total amount is 110, including both the long-term and short-term. When we subtract out the short-term or current portion, we get the remaining long-term, which is 103. When we report, we have the following if it's a discount bond. At issuance, you may recall, the bondholders paid less than the face amount. That's why it's called a discount. The bond payable is equal to your cash received, which is equal to the face amount minus the bond discount. If you got $746 million, that's the cash you got, so that is the net amount you owe. Now, the way we show it, though, is face amount minus the discount. We keep those separate. Why? Because over time, we're going to pay the face amount. So even though we only got $746 million in cash, eventually we're going to pay the full $750. In other words, that discount has to go away. So that discount is reduced from whatever it is at issuance to a smaller and smaller and smaller number until it becomes zero at maturity. Look at the formula. If this number is zero at maturity, then the amount owed will simply be the face amount, right? So that is the full bond payable at the maturity date. What happens to make all the numbers kind of work? What happens is called amortization. Whatever that discount is, it will amortize over the life of the bond until it goes away. The actual interest expense that is shown on the income statement is the combination of the cash paid, which is the coupon interest paid, plus this thing called amortization, which in this case will add to it because we're going to add to the expense so that we could get rid of this discount. The actual interest expense has two pieces, kind of a cash basis piece, which is based on the coupon payment, plus the amortization would boost it up a little bit here because we're going to boost it from 2.75% per year to 2.82%, right? And this amortization boosts it up by that little amount. So the numbers here are different from what we've used. This is in the book, but the idea is the same. So column E represents the net amount due. The face amount is $600 million, and the original discount is here, 16, I guess we'll say it in thousands. So 16,000 subtracted from 600,000 is 583. That is the amount of cash we received. Now let's look at period 1 year. The interest expense equals the net amount or the owed amount, this 583, times not the coupon rate, but the effective rate, that market rate. That is the 11,664. Now we paid a certain amount of cash. That's the coupon payment. That's 9,000. So the discount amortization is 2,664 in the year, the first year. Now the discount will then be reduced. So this amount is starting to creep up, right? So it started at 16, and the ending balance is 16 minus the 2664. So that's 14,140. So now the amount payable goes up to 585. So as this amortization occurs, this amount of the discount will also go down to zero, which will cause this amount to go from the 583 up to the $600 million. So at the end of the full 5-year period, we have a total interest expense of 70 million or 70,000, stay with the units. The amount we paid in cash was 54, and the little extra between the 70 and 54 is the amount of interest we amortize, which was effectively the extra interest we had to pay to get the bondholders to buy our bond. That is a discount bond. We can do the opposite. The opposite is the premium bond. I put in green here the words that flip from red for discount to green for premium. At issuance, the bondholders paid more than the face, oh, that's not a fact, face amount, so that's a premium. The bond payable equals the cash received, which equals a face not minus the discount, but plus the premium. When the bond matures, the company is going to only pay the face amount. So we have to get rid of this premium through a process called amortization. So the premium amortization will be to lower the interest rate because our effective rate was lower than our coupon rate. The formula is now interest expense equals coupon interest rate, but instead of being plus the amortization of discount, it would be minus the amortization of premium. And to show how the numbers work in the same example, we had 600 face, but now we got more money for it. We got 17,000 more. So 617 as the net amount due in the beginning. What is our interest rate? Our interest rate is effectively lower. So we take the lower amount, which is our interest expense. But notice the interest expense is greater than the cash we paid. The difference amortizes. So that will amortize down the premium from the 17,000 down to zero, such that at maturity, we're going to pay the 600,000. We actually paid $36,000. The cash we paid was 54, and the premium that we got paid in addition to the face amount is 17, and that's how it all works out. That's an amortization of a premium bond. So from a financial statement standpoint, we see things at maturity, and we have to show what happens when we get rid of debt. This case is an example of a bond repurchase by CVS, and it will show a loss on early extinguishment. And similar to what we saw in the sale of assets, here we're retiring a liability. It's actually, believe it or not, very similar. It's thinking of how much money did it cost you to buy off your liability. And it compares the amount you paid to the amount that was on your books. If you paid more than the amount on your books, you lost money. That's a loss on a retirement. If you paid less than what you owed on your books, you have a gain on the retirement. So just think about it as if you owe $1,000 to somebody and you're able to pay off the entire $1,000 for $600, you had a gain of $400, right? Because you used less money than what you owed them to get rid of the debt. The opposite can happen. You owe $1,000, but you can't get rid of it for $1,000. You have to get rid of it for, say, $1,100. So you paid $100 more than the book amount for that liability, which means you had a loss on the retirement of that debt. So just think logically, it was your money and paying more or less than what your books show that you owe somebody. And that would tell you if it hurts, in which case it's a loss, or it feels good, in which case it's a gain. Here is the formula, specifically here, gain or loss equals the net bond payable minus the repurchase payment, right? So that's the comparison. So fair value disclosures, there's a requirement that the company must disclose all the fair values, the market values at the balance sheet date. It does just similar to what we do for marketable securities under the passive size of the investment. There we mark to market and show fair values. We do not show fair values for liabilities because there's a presumption that we're going to pay it when it's due, in which case fair values is just fluctuations and not really relevant because you have no intention to buy and sell your bonds every single year. The presumption is you're going to wait until maturity, even though you have the right, of course, to do an early retirement.